Good morning out there, folks. This is Darius Dell to present our macro bundle live for January 12th, 2022. I'm joined by the late, lovely, and brilliant Nadine Terman, CEO and CIO of Solstein Capital. How you doing today, Nadine?
Good morning, Darius. How are you doing?
I'm
I
wonderful.
brought the fun for you today.
Yeah, no, we were chatting in the pregame. I've been looking for some animal print, silk animal print shirts for about 5 years now. So, unfortunately, they don't make them in my size. No, we'll appreciate everybody for the. We apologize for the technical delay. We'll just get right into it and try to get to as many questions as we can before we wrap up today. So, Nadine, what's top of mind for you today?
When I was looking at your materials, there's a few things that I thought that other people might have, linked onto as well. And then one talking about hedging commodities. So maybe you can walk through why you think it's important to hedge commodities, either broadly or technically.
Yeah, that's a great question. So, taking it to the chart deck. So we obviously put this the crowding analysis in the leadoff morning note as well, updated here in this presentation. And the one thing we found is sort of you kind of look at where commodities start to sit in this analysis. And as for those of you who are new, we're showing skew on the x-axis on a 1 year z-score basis, and the volatility risk premium on the y-axis on a percentage basis. And what you find is that a lot of commodities, particularly ag, the broader indices, commodities as an asset class on a median basis, they're now starting to inch towards this sort of spot where you want to be trimming long exposure. That typically is denoted by the option skew being bullish from a medium term perspective. But there's a build-up implied volatility premium, meaning that investors are starting to get nervous on the long side of starting to get nervous with respect to the long exposures, and so they're starting to hedge and increasingly pay up for that protection. One final thing to call out on that is that we've seen WTI, it's broken back to neutral, and that process of breaking back to neutral, it's still sort of hugging at the upper boundary of its probable range.
Yeah.
And so we know what's likely to come next. Obviously, when a security hugs the lower boundary or the upper boundary of its probable range, it's likely presaging a breakdown or a breakout in price to a better state from a volatility adjusted momentum signal perspective. So I fully expect a crude oil to transition back to bullish over some point over the next week or two, but that doesn't necessarily mean we can't see a quick pullback, to retest the lower bounds of the probable range and kind of shake the conviction of all the investors who, accurately bought the dip. Not sure they all bought it on the lows, but certainly investors have been coming back into this trade as evidenced by the chart pattern.
Thanks. And obviously, let's talk about the CPI print this morning. I know you've been unpacking the details behind it. It probably is on a lot of folks' minds right now. We saw the market pretty strong afterwards, and then it's been weaker from that point. Kind of, got Nasdaq only up 12 bips now, and it was something like 80,
Yeah.
off the bat. So maybe talk a little bit about how you view the print, and does that confirm, not confirm, or kind of just leave questions remaining about the grid model and the setup going forward.
Great question. So, I kind of say the headline on the CPI print this today was, it's a little something for everyone. Obviously, a seven handle is the highest print we've seen since before I was born. So, obviously, it's a pretty high level of inflation. In fact, taking it to slide 8, where we show our U.S. inflation model, it's kind of jumping off the top of the page. You actually have to pull the chart all the way back to 1982 to see a print that's north of that. So that's obviously negative as it relates to the Fed's reaction function, potentially being incrementally tighter now that this data has been reported. But more importantly, from a SAR basis, we've been looking at all the inflation data, particularly a lot of the year-over-year percentage change statistics that feed into our models. We've been actually kind of using the seasonally adjusted annualized rates to sort of front run kind of some minor reflections because, again, the pandemic's had some real outsized influence on a lot of the data. And when you look at it on a SAR basis, again, it's sort of a little something for everyone. So on the hawkish side of things, you had core CPI, that SAR ticked up to 7%. That's the fastest rate we've seen in a couple of months. But then on the dovish side of things, which is, in my opinion, I think that why the market was sort of so hyper reactive to the upside of the stock market, and kind of risk markets in general. One, I think it was the print came in line, and clearly the whisper number was for something that potentially was higher than 7% from a headline perspective. But more importantly, I think this is a real important takeaway, which is we're seeing inflation pressure really start to fade on a SAR basis, and this is starting to get broad based. Headline slowed to 6%. That's the lowest print we've seen in 3 months. Food slowed to 6%. That's the lowest print we've seen in 4 months. Energy slowed to down 5%. That's the lowest print we've seen. since May of 2020, and then lastly, shelter. This is the SAR that everyone's afraid of. It actually slowed in December. That's the lowest print we've seen in 3 months. And so, kind of the key takeaway on inflation, just turning over to slide 90 here. It's look, SAR is now starting to move in a direction that implies these numbers have to come down over the intermediate term. Obviously, if they, to the extent that they stay where they are, if they continue to decline back into a more normal range of inflation. And so we do believe that normal range of inflation is coming, at least from a tradable goods perspective. This is something we called out in our recent morning notes when you look at the ISM supplier delivery times data, which are effectively crashing as it relates to the most recent prints. We're seeing consumer confidence, inflation expectations tick down. We're seeing the NFIB survey data we unpacked yesterday. Those price components tick down as well. So I think we're moving past peak from a supply chain disruption perspective. But the other side of inflation, and then side of inflation, I think the Fed is most lagging and really not caught up to, in our opinion, is that the labor market is way too tight, and they're way behind the curve with respect to inflation or with respect to wage inflation.
So I think that gets to the other thing that everyone's dealing with, right? Portfolio construction. And it's
Mhm.
something we're talking about that I'm writing in our quarterly letter to investors. And how do you think about it? And our view is, you're renting it, you're not owning it.
Mhm.
Meaning that there's a window which you can't be betting against it and saying everything's deflationary,
Mhm.
but it doesn't mean you own all reflationary assets during that time. So I'd love to hear your views on obviously the print, but then your forecast. And then how do you translate that for investors watching you to say, well, what's the timing on this? Does it mean so we're going over the hump, so therefore you go all in now? Or, how do people think about that transition in your view?
Yeah, no, totally. This is a to be very clear. If we're bullish here, this is a needle threading exercise, and maybe it turns out to be a little bit bigger than a needle. But the reality is, we don't have the kind of economic environment that is likely to perpetuate a trending, lasting, sustained reflation trade. We have dynamics that are much more akin to perpetuating what could be a 1 to 2 month reflation trade, maybe 2 to 3 months on the long end of that, because this we know we're heading into a sea of D's from a bottom up macro regime perspective, and D stands for deflation. That's growth down, inflation down simultaneously. And so once you start to get into late Q1, early Q2, we're going to lose a lot of the positive growth momentum that we could potentially see, that we are expecting to see, that ultimately we believe asset markets are expecting to see with this newfound reflation regime, as a function of this sort of Omicron dynamic potentially crowding out other variants and making the pandemic effectively over and changing consumer and business activity, or consumer and business sort of person to person activity, and increasing the rate of transactions in that regard. From a portfolio construction perspective, is obviously that's all fine and dandy, but what you're really trying to do is effectively gauge how soon do we need to book a lot of the reflation exposure that we may have, or how soon do we need to book broader risk asset exposure. And the tools that we're sort of looking at, there's sort of two main tools that I think will really help us with that process. Number one, there's three main tools. One, it actually becomes, it no longer is the dominant market regime. That is obviously the most obvious signal, but I think the couple signals that may occur before that starts to happen is on slide 25. We look at our share of our sum of confirming markets analysis. The conviction score is just the total number of markets that are confirming the four regimes, shown on a percentile basis relative to the sample going back to 1998. And the reason that metric is important is because oftentimes low conviction scores, kind of let you know that you're at the beginning of a potential dominant regime, in so much that a high conviction score in the upper quartile, tends to be associated with kind of being in the later innings of a dominant market regime. So if we see this conviction score in this current reflation trade start to get north of 75 into the 80s, 90th percentile, we're going to be, hey, look, it's time to book it, because we don't want to overstay our welcome. So that's number one. Number two would be CACRI, which are just the combined shares of inflation and deflation from our market regime nowcasting process. And ultimately, what tends to happen ahead of sort of big market events to the downside is that CACRI not only dips its head into the consensus complacency zone, i.e., the combined shares of inflation and deflation dip below 20%. But more importantly, the back test tends to signal when you come out of that. And so we're already at 33%. So we don't have a tremendous amount of space to go in terms of dipping our head into that consensus complacency zone. But more importantly, once you come out of that, if we go in, once you come out of that, that tends to be a real negative signal. And then one final thing, I think I sort of thought of this while we are talking, but the final thing we're looking at as it relates to potentially, thinking about how to book some of the longer, higher beta riskier asset exposures in your portfolio to prepare for what could be a kind of a very material risk off event starting in and around kind of late Q1, early Q2, in our opinion. Again, that's our expectation. That may change pending further data, but that's how we're thinking about it now, is when the composition of our dispersion analysis really starts to change. And so what we're looking at in this chart is the month-on-month Sharpe ratio across 50 different U.S. equity and sectors and style factors and FANG names. And what we're trying to do is sort of see how the composition of the upper quintile changes relative to the composition of the lower quintile. And right now, we've gone from a state, kind of in November through December, where the upper quintile was completely dominated by defensives. Well, now, after the last couple of weeks, we've seen the upper quintile get dominated again, backed by pro-cyclical asset exposures like value, energy, high debt, things of that nature. So that's to the tune of 70%. If we see that number start to peak out and we start to see defensives coming back into the upper quintile so that it becomes more defensively dominant, we do believe that'll be a leading indicator for the ultimate peaking of the reflation trade that we're in now. But again, as I said, our expectation is that we may have a month or two at least to price that in.
And just for the new viewers, so I know you've been growing a lot, maybe explain what the top half of that chart versus the bottom chart, half of that chart is.
Yeah, thank you, Nadine. I appreciate that. Keep me honest, but yeah. So again, as I mentioned, what we're trying to show. So let me take a step back. Why do we show dispersion in this way? Kind of looking at the composition of the upper quintile versus the lower quintile. The reason we look at the market and parse apart the market this way is because we're trying to identify what sectors and style factors sort of the higher frequency of trading investors are sort of rotating into. These are your kind of the types of investment managers that tend to dominate equity market turnover. These are your pod shops, your multi-manager platform shops, your quant TTA type of hedge funds. These are the types of funds that really move the market on any given day or any given week. And so what we're trying to do is by looking at this on a Sharpe ratio basis, sort of Sharpe ratios more align the performance with something that looks like flows as opposed to just sort of, gappy price changes, percentage price changes. And so we're effectively trying to quantify, hey, are the fast moving, fast money, sort of higher frequency trading investors, are they allocating capital at the margin towards more defensive sectors and style factors, or are they allocating capital at the margins towards more cyclical sectors and style factors? And that process of allocating towards more cyclical sectors and style factors really began in earnest over the last couple of weeks. And this is something that's obviously front ran the evolution of the current reflation regime that we're now mired in. And ultimately, we think it'll front run the end of the regime.
Thanks. We were talking a little bit about one of the charts that I was looking at, basically showing that, because everyone else has the question too, is how long do you stay in that value trade, right? Because that's all the headlines. And basically, value does well when earnings growth is accelerating, and value versus growth doesn't do well when earnings aren't accelerating. And obviously, I know your data, and this year there's lots of Ds, which would be a decelerating growth in GDP, with decelerating growth probably in a lot of earnings. And so that doesn't mean it's across the board, but obviously, like cyclicals don't tend to do well in the deflationary environment. So maybe, what are your thoughts on that? Our view that is you obviously rent the reflation trade, but you don't own the reflation trade. And it seems like that's what you're getting at. And it's the timing, it's those technical signals that you're looking at, it's the flows, the three charts that you just saw the inflation plus deflation versus the G and R ratio. And would you agree that that's really going to help you understand it? But you need growth for value, and we may or may not have that this year.
Have a sustained breakout in value relative to growth, you need sort of a couple things to happen, right? Number one, obviously you need financial conditions to comply. You don't need credit spreads widening. You don't need the dollar breaking out to the upside. You don't need sort of real interest rates breaking out to the upside. Would tend to be positive for value, but generally speaking, you don't want to have a tightening financial conditions. And more importantly, what you typically want is an acceleration in growth, and that's exactly what we got. Kind of this record acceleration of growth coming off the lows in COVID that really sort of peaked and petered out in the middle of last year, which is exactly when, go back and fact check me on this, is exactly when we thought it would peak out and the whole value trade would peak out. And so ultimately, right now, investors have been sort of, the market is really sort of forcing investors to want to chase value. Obviously, it's created a lot of performance bleed for a lot of active managers in the year to date, but we would just as soon not chase value in its more pure form. We do believe there are pockets of the equity market that may do well if you continue to see a reflation trade, value included. But certainly from this particular interval, I mean, obviously value is extremely oversold relative or overbought relative to tech. But the reality is this will be the first thing that people sell when people start to the discount the market moving into a more deleterious regime. And ultimately, that's everything I just talked about in terms of our sum of confirming markets, conviction score analysis, the share confirming markets and analysis, that process, and ultimately the dispersion analysis, which should be a leading indicator for all that. That's when we'll start to see investors really start to book gains in value. But for now, value safe, but it's certainly a exposure you'd have to rent to the extent that you are going to chase it.
And let me get to one of the questions from Carlos Cruz before I get to my next question. One of his questions is about your position sizing. You use 260-day realized vol. What's your reasoning for using that time frame as opposed to a different time frame? So why pick that one out?
Yeah. So what slide is that? Slide 44. So the number one reason I use that time frame is because institutional investors use that time frame. I talk to when I talk to sort of the risk managers at one of the world's largest and really famous this week actually, in terms of their risk management systems, they're looking at 1 year, 2 year crossovers in terms of realized vol, in terms of gauging and guiding their position sizing. And so I thought of kind of making sure that we're anchored on a similar time frame because these are people who are much larger teams and resources and smarter than I am on a lot of this stuff. So I just assume go with that. And also, what you don't want is having a shorter term observation window that's obviously going to be sort of much more hostage to recency bias, recent price changes. And so I think a 1 year look back gives you a decent sense of how the asset behaves over a decent enough time frame. Because again, we're not long term investors. We're short term risk. We're medium term risk managers. We're neither short term nor long term. But at the end of the day, we're not putting positions on with the expectation that we're going to have this, for 2-3 years. We're putting a position on with the expectation that at most it'll be 12 to 18 months for any given exposure.
So is that a trading days or is that actual days, the 260?
Yeah, trading days. Yeah, so this is 1 year look back.
Okay, great. So you got that one's off. So now I want to turn to something that you mentioned this morning about Bitcoin.
Oh, yeah.
You said, you need a bullish skew in order to really go whole hog into Bitcoin because there's some positive signs, but you need a bullish skew. So people may question what that means.
Mm-hmm. Yeah, so this is interesting because after talking with Imran Laka of Options Insight the last few times he's been on the program, and sort of explaining us to kind of the volatility dynamics in the crypto market, one thing that's become obvious to me is that, hey, look, crypto skew, its natural state is bullish to the call side. It's positive. I mean, calls are more expensive than puts. That's its natural state. And it's the same way with meme stocks as well. And the two things that both crypto and meme stocks have in common is that their price change tends to be positively correlated with their realized volatility. To the extent that you do see higher prices, you're typically seeing higher prices on higher volatility. And so that's, in our opinion, why the sort of, kind of the structure of skew in those asset classes tends to be kind of, in that positioning. So clearly skew has really come in a decent amount in terms of favoring puts in cryptocurrencies. And so we like to see that start to widen out again in favor of calls, which means the dot is actually going this way. I know it says trim longs in this box, but again, we're talking about an asset that's very different than all the rest of the assets with the exception of the VXX.
Latch on to is KBA. Obviously the data came out today that there's lower inflation, or at least that's what they're printing, and slower growth, but you expect it to inflect later this year. And you point out that it's one of the most undervalued or significantly undervalued assets there. So it'd be great if you could unpack that a little bit.
Yeah, absolutely. So do I have the China back test? Let me pull that up. So I actually updated the China valuation model today, and I mean, we all know China's cheap. Just look at the chart.
Yeah,
cheap.
Yeah, but everyone's like, where do you go, right?
Yeah. And so
it's cheap, and you can stay cheap for a while. So you see the growth of GDP accelerating potentially, right? And assuming Omicron doesn't shut things down again for them. But it'd be helpful for you to kind of point out why you made that statement today.
Yeah, so I made the statement on valuation today, sort of by happenstance, because we were writing about China, and the growth continued to decelerate and inflation continued to decelerate, which obviously is a negative environment for nominal GDP growth. But then when I sort of updated the model, it would say, look, this model is designed to show the next 12-month price to earnings ratio for the benchmark equity market as a spread relative to the price to earnings ratio of the MSCI World Index, so the broader global equity market. We show that spread on a 1-year Z-score basis as an opportunity for when this asset class is overvalued or undervalued relative to the broader equities. And we're now registering a -2 sigma in Chinese equities. So that tells you that a lot of the growth slowdown that we have sort of upcoming over the next couple of quarters, in our opinion, is largely priced in. Now, it's not that we'll never know if it's truly priced in. We'll only be able to understand or ascertain that in hindsight. But the reality is our models have Chinese growth bottoming in March and inflecting higher from there. And ultimately, by the time we're in June, we're trending higher in growth. And so we do believe asset markets between today and March will find a bottom and ultimately have to start to price in this recovery. And the one thing I'll say about China that's very different than the rest of the world is, you're going to see China accelerating. It's highly likely that you see China accelerating throughout 2010, or sorry, not throughout 2022, while a lot of other countries in the world are in this sea of deflation. And so to me, I think you're going to have a more favorable monetary and fiscal policy dynamic in China, if only because they're not tightening. And you're also going to have more favorable growth and inflation dynamics as well. So we do believe the valuation discount that China's earned over the last 12 months or so will start to get unwound at the margins.
And John's asking, thoughts on KWeb versus US tech. So part of it is you're in the KBA, not KWeb. But if you had to compare US tech to China tech, I don't know if you've done that, but that's John's question.
KBA, and the reason I say, the reason I say that is that if you look at kind of where all the China dots are in this crowding analysis, you have KWeb down here, Chinese yuan down here, FXI down here. Like you could be potentially setting up for a final leg lower in those assets because the options market dynamics are favoring correction in those asset exposures. But we'd be dip buyers of that. I don't think we have too much more downside in this China trade, if at all. And ultimately, we do believe this is an area where you're going to want to be in 2022, particularly not now, because the whole world's reflating in terms of investors applying better multiples, tighter liquidity premiums in international markets, in value in the U.S. market. So there's other places to be for now, but increasingly as we progress throughout the year, and this is something we can unpack as well, we think the probability that the Fed is likely going to be tighter than investors currently think is high. And we also think the probability that they will be unable to pivot back towards easy, even if financial conditions start to tighten in a material way. We also think that probability is really low that they'll be able to pivot back to easy. So that's my long-winded way of saying the Fed put, particularly for asset markets that are, kind of U.S. oriented, U.S. centric, is materially lower than it has been in recent years. And I think that favors being long China relative to the U.S. as we get through the year.
And sorry, Joel's question was the 260-day realized vol, not Carlos. Then DB asks about Brazil. What do you think about re-entering Brazil, given your forecast for growth later this year?
Yeah, no, I mean, I think it was a bad sell. I mean, certainly one of the mistakes we've made in recent weeks. I do believe Brazil. A lot of what we said about Brazil, kind of going back to when we outlined the trade in early December, I think it still holds true. I worry about Brazil. I worry about markets that are sort of less able to sort of control their own destiny in an environment where the Fed is tightening monetary policy, an environment where fiscal policy in the U.S. and in large pockets of the world are normalizing. And more importantly, I worry about that in the context of a growth slowdown in kind of these important markets, right? The U.S. is a very important market for Brazilian exports. Not that that really matters, but I do believe that you're talking about a global slowdown. I think China has the sort of the easy comps, the monetary and fiscal space, and the scope to ease to get you through what could be a very difficult time for the global economy. Whereas I don't think Brazilian inflation is going to come down enough to give them that same setup that China is likely to enjoy. And so maybe Brazil's kind of a 2H22 story after we see some corrections in a lot of other asset classes, high risk asset classes. But for now, I think it's likely to drift higher with a lot of other risk assets. So that's my long-winded way of saying I wish I didn't sell it, but I certainly did.
And when you look at your portfolio construction, obviously there's tech in there. You got a little bit of energy recently. You've got treasuries, right? When you think about that on a short-term basis versus your, second half of the year basis.
Mhm.
What makes you most nervous about that construction?
So the game plan, going back to everything I said, that might start to give us signals that the reflation rate we're currently in is peaking. The game plan is to get rid of everything in the reflation box immediately,
Yeah,
with the exception of China, unless China is acting poorly enough to warrant getting rid of that as well. So already you have 15, 18% of cash you're raising, sort of when we see the
sure.
reflation rate starting to peak out. And then you start to move right on the chart. Okay, so we're putting this 18% in cash, and then you start to move right on chart. Which of these do I really want to be long in an environment where growth is slowing, inflation's slowing? We're talking about Federal Reserve rate hikes. We're talking about quantitative tightening eventually, and sort of maybe Q2, Q3 is the time frame on that. And the reality is, when you look at our back tests, we programmed all this into our grid asset market back test process in terms of deflation. Having growth and inflation slow simultaneously at a moderate pace, policy rate tightening, balance sheet tightening, fiscal policy tightening, the rest of the world in the similar economic regime. And when you look at kind of a lot of the stuff we're long, from a mega cap tech exposure, momentum, quality, a lot of that stuff, or sorry, momentum and quality should be okay. But a lot of the tech exposure that we
Yeah,
have,
gotta go.
construction's got to go as well. So
Yeah.
we're talking about raising a significant amount of cash, into whatever the peak of this reflation trade is, because we know that this is the next most probable setup. And that's how the process works. So, that's why we show these things simultaneously. We're saying, hey, look, let me program the back test for everything we think the market is pricing in today. Let me program the back test for everything we think the market will have to
Gotta
price
go
in
to.
tomorrow, and then help you sort of navigate from today to tomorrow. And
And in
ultimately,
your mind, I mean, that's a point, right? So do you keep in cash until you want to deploy back into, GRI, or do you actually put the cash into the deflation? Because as we know, sometimes you can make money in that deflation trade, and then other days everything goes down. So you're not making money. Bonds and equities go down. So maybe help everyone out in your view, and I can give my view too. What do you do with that cash?
yeah, well, the more than bonds are obviously the most likely target for a lot of the cash we're raising in terms of rebalancing the portfolio construction. Right now, we have 20% of the portfolio construction, or sorry, is it 21%? Let me double check. Yeah, 21% of the portfolio construction currently in fixed income and FX exposures are all long bonds. That 21% could easily go to 42%,
Yeah.
kind of in a heartbeat, in terms of increasing our exposure to that. But the reality is, I take it back to this chart here. Like, this is where we are in market cycle terms.
Yeah.
If you look at the blue line in this chart, is the OECD composite leading index for the world. So the kind of the estimation for global growth, where we are in the global growth cycle. The black line shows the S&P 500 high beta to low beta ratio, and then the red line shows Bitcoin treasury bond ratio. And historically speaking, you've seen about a 30% correction in high beta risk assets, or high beta stocks relative to low beta stocks, and about a 75 to 85% correction in Bitcoin. So we're using these as proxies to show you how much terminal downside we could see if the blue line does what our models are suggesting it's likely to do, which is continue lower over the intermediate term. So that's again, I'm being long-winded today, but that's a long-winded way of saying I'm not in a hurry to buy anything. Once we make those sells at the peak of what we see this inflation trade and getting out of a lot of that tech exposure, we're going to have an elevated amount of cash once we
Yeah.
stop buying bonds, and I'm happy with that, because again, we're at a very asymmetric point from a market pricing perspective, and also, in our opinion, a very asymmetric point from the perspective of Federal Reserve policy.
Great. Any questions that you have? I don't have any more questions in the queue here from viewers, so I figure I'd turn it over to you.
Yeah, absolutely. So I did want to pick your brain on sort of, kind of how you thought about, managing this reflation exposure. Obviously, you guys have different considerations and constraints on what you can do and how much you can do in terms of mismanaging some of these shorter term moves. So just picking your brain on what you guys have done to manage this in the last few weeks.
Sure. So, we had energy exposure. We had trimmed some of the financial exposure. So I'd say coming into the new year, probably light. We had more European financials, I should say that. We had more European financials, fewer US financials. We had some Asian financials. So obviously, then the question is, do you go add to that bucket here in the US? We preferred to add internationally. In terms of energy, we just kept it. So we kept the exposure, but we're obviously watching for signs to maybe trim that exposure uh, versus, again, because now we're kind of getting overbought signals as well on our trading ranges. In terms of the defensives, we did play the last few days. luckily well, in terms of, taking off shorts, riding it up, buying into the bottoms, and then trimming a little bit. And so it's been a little bit more active the last few days in those accounts that require that or look for that. But when you're talking about people who are trying to, really manage for taxes and take more intermediate term positions, we actually came in with a lot of cash in some of the accounts. And so while we did deploy some, we're actually sitting on probably more cash than a lot of people sit on. So we don't have to put on as many shorts to weather the storm. We don't have to go whole hog in to make up any major deficiency in returns. And so on the margin, we've played this, and then, as I said, we're thinking about more renting this reflationary trade on the energy and the financial side. We have industrials, but they're very specific. They're more fundamental. It's not an oversized area for us. And then we didn't go as sizable, as you did, into bonds and bond-like securities other than real estate. So I'd say we have, 3/4 positions in real estate, but we were light on utilities, light on staples, light on the treasuries and other fixed income. And so the question has been around, we added a little bit into that. But, when do you go whole hog into that? And it seems like that's also part of the rent versus own reflationary trade is you don't want to go whole hog yet into that. But you do want to have call it a starter position, but we're waiting a little bit till we feel like we have a better sense of timing on that, because you don't want to be caught off guard with headlines, as we've seen the last few weeks of raising rates faster, higher, and pulling liquidity faster, because that just tends to really kill those securities that are supposed to be, from your chart on the 200, 80, 60-day realized vol basis, lower beta. They end up not being, right, during those periods. So, we have to, one of the things we always look at is you think something is on, longer term, whether it's averages or the history, but in those periods of time, just like we saw in the first quarter of 20, we had oversized, bonds and gold and cash and shorts and options, but you had to take those off before March, because then everything went down. And so you had your shorts on, but you needed to get out of your gold and your bonds. So you got to be a little bit careful. It's not just from the rates play, but I guess the liquidity play. So where are people, putting their capital versus sitting on the sidelines or pulling their capital. So that's kind of a multi-layered game that we're thinking about as we're building these positions, right, and taking off positions. Aaron, we actually have a few questions here. Anders, just so we get to them, the underpinning of the process of the rate of change forecast on growth and inflation helped my conviction in following the process. I understood more precisely how this forecasting process works and how it differs from consensus with regard to methodology, if it does. Thanks.
Yeah, absolutely. So it's I'll be quick on that. It's pretty straightforward. Starting with what is the process, right? So we're running two models at all times to predict growth and inflation for every economy. And sort of the first model is sort of the stationary mean reversion model, which is a pretty standard sort of stationary mean reversion model for
Yeah.
the time series itself. And then the second one, we're actually using the component features, running each of the component features in the nowcast model through that process, ultimately to predict sort of our expectation for where a lot of those features are likely to wind up over the intermediate term. And then we sort of just find the mean and the median of those two forecasts, which ultimately feed into the actual grid regime projections that you see here and the probabilities associated therein. In terms of how we differ from consensus, I'd say that the primary difference is, instead of looking at GDP as the growth feature, which obviously it's a lag, one of the most lagging economic statistics, but more importantly, you're not getting a lot of data. You only get 4 GDP reports, where you technically get 12, but you're only getting real 4 actual reports throughout the course of the year. So it's hard to update and understand where you are in the growth cycle in the interim without being overly reliant upon sort of forecasts and things of that nature. So this OECD composite leading index time series data is extremely powerful. These data sets go back to the 1950s for a lot of different economies, and they
That is, because people are like, so, Anders is going to hear that, but he's not going to know what that is. So, because it sounds like he's new to this process. So what is, the OECD CU? What is that?
Yeah, so the OECD is the Organization for Economic Cooperation and Development. They maintain sort of development programs and economic statistics for a sort of cross-country comparable economic statistics for all the developed market nations and all the large emerging market nations. I want to say all the countries that they interact with is somewhere around 90% of global GDP. So it's a pretty meaningful balance. But this time series is really important because it measures the sort of the distance from the mean, or so not from the mean, the distance from the sort of trend in a lot of the sort of higher frequency time series. And so it's a leading indicator. So it's got things like, sort of like for the U.S. economy, like jobless claims would be a leading indicator or something like that. So all the sort of bottom up economic statistics per economy are different, but it's whatever they've back tested as sort of having the most predictive power in terms of front running changes in the GDP cycle. And so for the average economy, this data set tends to sort of peak and trough, roughly 2 to 3 quarters ahead of the peaks and troughs of the GDP cycle. So it's a good leading indicator in that regard.
And then in terms of versus consensus, one thing that you just mentioned was versus GDP. And then I think the second one, it probably relates to like, what do you do with it, right? And this is from a user. So Darius, provides you per country and sometimes per region, like the Eurozone, this forecast, but he marries it with the technical. And so understanding the timing of when you make the positions, this is giving you a map of where things are headed. And he also gives you a map of what things tend to do well. You've got all the dot plots of what does well per region or geography in each of the grids. But it's looking at how do you then execute it, I think relates to your technical measures. It's the timing of that to say like which one is asymmetric, either from flows or options or whatever the underpinning of the analysis is, Anders. That really gets to then what do you do with this data? Is that
Yeah,
helpful?
yeah. The number one thing you do with this data is understand where you're going to be from a 3 to 6 month conditional probability perspective. And that's how we orient our portfolio construction, which is trying to allocate to the grid regimes that have the highest probabilities, or at the bare minimum, allocate corresponding with the probabilities. And so, as you can see, over the next 3 to 6 months, kind of inflation and deflation are the primary regimes. And so that corresponds with our portfolio construction, where by inflation and deflation have the highest shares of the total amount of capital that we can potentially invest. And so that's sort of the main process, which is understanding what the model is saying, where we're likely to be from a growth and inflation perspective over the intermediate term, understanding how those deltas correspond into calculating conditional probabilities, and ultimately taking those probabilities a step further and representing those probabilities in the portfolio construction.
Before we get off this to Brian's question on India, do you want to hit John's question? What would be the main daily indicator that would tell us to dump the reflation trade? Maybe you answer that, and then I'll give my answer on that.
So I'll give a abridged version of the answer that I gave earlier, which is I answered this question sort of verbatim earlier. So
he's looking at like if there's one thing daily that he needs to like follow versus what in your mind, which is the one that he should most care about.
Our Lord and Savior Jesus Christ. If you have to pick one thing, I mean, there's no one thing with any process. I mean, that's I have 132 slides in this deck for a reason. It's because there's not one thing, John. If you want to make it down to one thing, I guarantee you're gonna have a ton of success. And so let me go give you the 3 things that I think are most important, because they all attack the process and the problem from different angles. The number one angle, so what if inflation becomes really strong and a very dominant regime and lasts for an extended period of time, i.e. more than a couple of months? The number one thing we look at in that scenario is the conviction score breaching its breaching into the upper quintile, because that typically is associated with sort of crowded positioning that tends to find itself unwound. That's exactly what happened here in June when we made the call that the reflation trade would end then. The second thing we'd be looking for is just a return to a dominant market regime not named inflation, and more importantly, a dominant market regime named inflation or deflation, which will obviously be more risk off than the reflation trade itself. And then lastly, CACRI, or sure, not lastly, there's 4 things, I guess. CACRI, it's sort of, this is more or less in line with what I said earlier about the conviction score being high. That's likely to be associated with CACRI coming into, and more importantly, out of is the important signal of the consensus complacency zone, because historically that's when you've seen some volatility in financial markets start to develop. And then at the very last, and I know I'm being long-winded with my short-winded answer, which was the composition of the upper quintile of our dispersion analysis starting to fade from a reflation perspective and actually starting to build back into defensives, seeing investors, sort of pod shop type investors, CTAs, quants crowding back into defensives. That to me would be a fundamental move ahead of what could potentially be a a trending bout of cross asset volatility. So sorry, John, to not give you the one thing you want, which is waking up and reading kind of a one sentence summary on how to manage all of global macro financial risk. But unfortunately, it's not that easy, my friend.
And John, one thing I do is read Darius's work and listen to that in the morning. And the other one, and hopefully we'll make this available to all of Darius's folks, is trading ranges. So if you can see that all the value trade or reflation trade is hitting overbought signals, right? And sometimes it means, oh, this thing is going higher, but oftentimes, like, you're going to revert back to the mean. And so what you want to be watching is the implied volatility. You want to be watching the trading range to see if you're having this huge pattern of overbought signals. That, in addition to Darius's work, which is kind of, embedded in Darius's work, for us helps us understand, like, okay, like, you need to trim some of these positions at least, and or start thinking about hedging the positions if the data is showing that this could last longer from a macro perspective, but from a near-term trading perspective, you're getting a lot of risk. So a good example might be oil now. So maybe you want to trim some of that, your energy positions, or you need to hedge the positions because it's come more of a consensus position. There's a lot of overbought signals. So those are the types of things you would do. And then once you're getting like confirmation over days that yes, this is something that has persistence, then I think you can more heavily handed start to take that as a sign to position more strongly with the portfolio versus just hedging.
That's brilliant.
That's what we do. So I don't know. That's what we do.
Yeah.
A couple other questions we have here. So Brian has India. Any comments? It's had a big dip, since been on a steady rise. What do you do with India?
I mean, it's certainly one of the places you can play for reflation, but I don't think it's a longer term holding. You're not going to want to be long India when the Fed starts QTing, I guarantee you.
And last one here we got from Craig. Can you explain how the vol adjustment works with regards to the dominant market regime? So for example, there are times the VIXN is bullish, but so is NQ1. I would think that a bullish, VXN would at least make the NQ1 neutral at best.
Yeah, no, that's the premise of the question is wrong. That's impossible. That wouldn't occur.
Because vol goes up. That's different than Bitcoin. When the vol is going up on that, things are usually not going
bullish, and the Nasdaq can't be bullish. One of the components for making the Nasdaq
something's going to go wrong. Yeah.
Yeah, it's all right. That is a quantitatively linked process. So
yeah.
All right. Thanks, Craig.
So those are the questions we have.
Yeah. No. Let me summarize real quickly. This is a phenomenal setup. I think we're at a very interesting time in financial markets right now. We have what could potentially sort of materialize into a fundamental reflation trade if Omicron is what I think Omicron is, which is sort of the harbinger for the end of the pandemic. Ultimately, we do believe you're going to have to face this reflation trade. We're heading into a economic environment where growth is normalizing, inflation is normalizing, monetary policy is normalizing, and fiscal policy is normalizing. And historically, that's not been a great concoction for risk assets. And more importantly, we're coming off some very asymmetric highs, both in terms of price, relative price, valuation, and relative valuation for high beta risk assets. So I just want to make sure everyone has that message very clear in terms of what the game plan is and what to be looking for in terms of making some of those pivots back to a more defensive posture.
It's been fun.
Thank you. Appreciate it. Thank you so much, Nadine. I appreciate you joining us. And thanks everyone for joining us. We'll catch you back here next week. We have Afonso Pecatiello to sort of, I believe we have Brent Kachuba of Spot Gamma, CEO and founder of Spot Gamma, joining us next week to talk about OpEx and all those interesting dynamics with Gamma and all that stuff. So looking forward to that. Cheers.
All right. Have a good day.